Hello and welcome to Edison TV. I'm Miłosz Papst, Director of Investment Companies Content at Edison, and today I'm joined by Alan Gauld, who's Senior Investment Director in the Patria Global Private Market Solutions team and the lead portfolio manager of Patria Private Equity Trust. Alan, good to have you back.
Thanks for having me, Milos.
Patria Investments has recently become the trust investment managers. Maybe you can start by giving us some background and how it influences the trust.
Yeah, so the transaction with Patria concluded in April of 2024. So that's us been within Patria for the last 6 to 9 months. And it's worth taking a little bit of a step back. Previously, we were owned by Aberdeen. Our business within Aberdeen was around $10–11 billion of AUM. But in the context of a large asset manager like Aberdeen, which is 500 billion or so, quite a small part of their business, and strategically it wasn't central to their plan going forward. So we were discussing with them in terms of ownership, what's the correct ownership structure. So a decision was taken by Aberdeen to sell the business, and Patria were the management team's preferred buyer in the end, and put in the highest price. And so that transaction signed in October of 2023. And with the various complexities of closing a transaction of this sort, including regulatory approval, closed in April, as I mentioned. And really, since the transaction signed, Patria have invested behind the team. So we've added 15 new hires across our operations team and also our investment team as well. So really supporting us with regards to our team and the growth of our team. So that's the immediate sort of impact of Patria's ownership. But Patria are a private market specialist. They've made their name in Latin America, but they really understand our business. And our business is around 20 to 25% of their overall AUM. So we're really central with respect to their strategy going forward.
Excellent, thank you. That's very useful background. And now you have recently completed a successful £180 million secondary sale. So I'd be keen to hear your thoughts on this transaction, especially what kind of context does it set for the discount to NAV at which your trust is trading, and how do you plan to use the proceeds?
So it's worth mentioning that our team has a dedicated secondary team. So we're constantly monitoring the private equity secondary market, both from a buy perspective and also a sell perspective. And we got a sense this year that the secondary market was really hotting up and there was a lot of demand for quality buyout fund positions. At the same time, it had been a while since we'd really, shall we say, cleaned up the tail end of our portfolio. And so we looked to instigate a transaction involving basically a bunch of fund investments that were on the periphery of what we were doing, frankly, and were a little bit older in terms of maturity. So we pulled that together and conducted a short process, and a secondary buyer put in the highest bid and equated to around 180 million of the valuation of those funds at the 31st of March 2024. And that allows us to simplify our portfolio. It frees up cash for new investments. This is an evergreen vehicle, so we can invest that in other areas that we think are more core to our strategy going forward. It provides more cash for corporate initiatives. For example, if we want to extend our buyback program, which is ongoing, as well as de-gearing the trust somewhat as well. So we think it's a really neat transaction at this point in time. Pricing was 5% discount to NAV, which we consider very competitive in this market. And when you compare that to the share price discount to NAV of the trust, we think it's a good trade for shareholders as well.
Thank you. That's very useful background. And now maybe you can talk a little bit about your co-investment portfolio, which you have been expanding over the years, and how it has been performing recently.
So if we take a step back, we introduced co-investments to PPET's investment objective back in 2019, the start of 2019. And we consider co-investments and single asset secondaries as our direct investment portfolio. So when we started that in 2019, we had no exposure. Today, we've got 32 companies that are direct investments, and that equates to around a quarter of portfolio value. And so far, so good in terms of performance. The direct portfolio is outpacing valuation growth of the fund portfolio. We've seen partial realization from our co-investment in Action back in 2023, and we saw our first full realization from the direct portfolio, which was a business called Mademoiselle Dessert, a premium frozen pastry manufacturer and distributor, when IK sold that business to a Swiss trade buyer earlier this year. So we're starting to see the fruits of this portfolio emerge. Just as a reminder, direct investments bring the advantage over fund investments that they have lower costs attached to them. Often co-investments have no fees or carried interest attached to them. So that gives you the potential for outperformance, assuming you get your selection of direct investments right. So that's the key benefit, but also gives us benefits with respect to portfolio construction. We can be a lot more targeted and shape our portfolio much more actively with directs vis-a-vis funds and cash management as well. Because direct investments are funded largely upfront, we can manage our cash that a little bit easier than with funds, where typically you make a commitment and then the funds are drawn over a long period of time, often around 4 or 5 years.
Excellent. You've discussed the strong demand you've seen in the secondary market, and it seems that overall the global M&A market has been warming up as the interest rate cycle started to turn. So maybe you can give us some flavor of what do you see in terms of deal activity in the private equity markets and how it translates into capital calls and distributions from your fund investments.
Well, certainly since interest rates started to rise in 2022, private equity activity has fallen. It's been harder for buyers and sellers of private equity assets to price and meet in the middle. The so-called bid-ask spread has been in play and has been quite wide. But really, since about the second quarter of 2024, we've seen a meaningful pickup in activity. We've seen some notable larger transactions in Europe. From our portfolio, I would call out the likes of Hermes, the parcel delivery business, being sold by Advent to Apollo, the likes of the company that holds MotoGP, being sold from Bridgepoint to Liberty Media. And as I mentioned earlier, our first direct investment, Mademoiselle Dessert, was sold in the second half of the year. So we've seen a meaningful pickup in activity, and we think that's a good sign of things to come, really. Drawdowns and distributions from our funds, for example, drawdowns last year outpaced distributions for the first time since 2010. However, we've seen that reverse in the second half of 2024, and this is really positive in terms of not only the cash flow back to PPET, but also NAV growth, because typically private equity firms exit their underlying portfolio companies at a higher valuation than they hold them at. So has the potential to drive NAV growth as well as cash back. But as we move to 2025, we're seeing more and more positive signs that this increase in activity will continue. And I think things like interest rate cuts, assuming they come through, they will also catalyze this increase in activity. So we feel very positively if we look ahead to next year.
Great, thank you. You've mentioned that as interest rates started to rise, the bid-ask spread widened in the private equity markets. And it seems that now as interest rates start coming down, the gap between the buyers and sellers' expectations again starts to narrow. So maybe you can give us some additional comment on what you see in terms of PE valuations in the context of the pickup in deal activity.
Well, I think with private equity valuations, the proof is always in the pudding when an asset is sold. And even since interest rates rose, we've seen the private equity transactions in our portfolio anyway continue to be conducted at an uplift in valuation. So last year, that uplift upon exit on average was around 18.5%. So far in 2024, that uplift has been around 23%. And longer term, we see that uplift as being around the 25% mark. So we've not really seen a change in that phenomenon. It remains in place and is a good sign on the underlying valuations for these businesses. What I would say is that really over the last 18 months or so, it has been mainly the more recurring revenue, less discretionary assets that have traded. So think business-to-business mission-critical software, some parts of healthcare as well, some consumer staples businesses. So it has been those more resilient, recession-proof assets that have sold and continue to be sold at an uplift. What we're starting to see now is those more discretionary sectors beginning to be sold again, and we'd expect that to be the case as we move forward. But yeah, from our point of view, I think that the whole debate about private equity valuations has been slightly overdone. We continue to see assets being sold at uplifts, and that is a really good sign in terms of the underlying valuations of private equity portfolios.
Alan Gauld, Lead Portfolio Manager of Patria Private Equity Trust. Thank you very much for your time.
Thank you, Milos.